Hi guys! Enjoy John's analysis.
It is January 11th, 2024. Imagine Jack, a 62-year-old retirement planning consultant in Dallas, Texas. He sits down at his computer at 9:30 in the morning. He opens his Fidelity brokerage account, the same account he has used for 23 years to buy shares of Apple, to hold his S&P 500 index fund, to manage the portfolio he has spent a career building. He types 4 letters into the search bar. FBTC. He clicks buy. He enters a dollar amount. He confirms the order. In 30 seconds, he owns Bitcoin. He has never created a crypto wallet. He has never heard the words private key. He has never downloaded an exchange app, never gone through identity verification on Coinbase, never worried about what happens if he loses a seed phrase. He bought Bitcoin the exact same way he buys everything else, through the brokerage account he already has, with the protections he already understands, inside the regulatory framework he already trusts. This was not possible before January 11th, 2024. Not in any meaningful, accessible institutional grade form. And the reason it was not possible, and why it suddenly became possible on that specific date, is the entire story of this video. Let me start with the foundation. Because to understand what a spot Bitcoin ETF is, you first need to understand what an ETF is. And to understand why Bitcoin needed one so badly, you need to understand why every alternative that existed before January 2024 was structurally inferior in ways that mattered enormously to the kind of capital that moves markets. An ETF, an exchange-traded fund estimate, is a financial instrument that tracks the price of an underlying asset and trades on a stock exchange, the same way a share of stock does.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
When you buy a share of GLD, the SPDR Gold Shares ETF, you're not buying a gold bar. You're buying a share in a fund that holds gold bars in a vault and whose price tracks the price of gold in real time. The fund handles custody, storage, insurance, and logistics. You get exposure to the price of gold without ever touching gold. That structure solves a specific problem. The problem is access. For most investors, particularly institutional investors like pension funds, endowments, registered investment advisors, and wealth managers, buying an asset directly comes with enormous friction. It requires custodial infrastructure. It requires regulatory approval. It requires legal clarity about how the asset is classified, how it is taxed, how it appears on a balance sheet, what fiduciary standards apply when recommending it to clients. Most large pools of capital cannot simply open a Coinbase account and start buying Bitcoin. The compliance frameworks do not allow it. The custodial infrastructure does not exist at the required institutional standard. The regulatory classification is unclear in ways that create legal liability. An ETF resolves all of that friction in a single instrument. The ETF sponsor handles everything on the back end. The investor buys and sells shares through their existing brokerage infrastructure. The asset becomes, for regulatory and operational purposes, just another security. This is why gold ETFs changed the gold market permanently when GLD launched in 2004. Before GLD, most retail investors who wanted gold exposure had to buy physical gold coins or bars, deal with storage and insurance, or buy gold mining stocks as a proxy, which is a very different risk profile. After GLD, any investor with a brokerage account could own gold with one click. The result, hundreds of billions of dollars flowed into gold through the ETF wrapper over the following 2 decades, from investors who either could not or would not access gold any other way. Now here's the distinction that matters enormously for Bitcoin specifically. The difference between a spot ETF and a futures ETF. A spot ETF holds the actual underlying asset. When you buy a share of IBIT, BlackRock's iShares Bitcoin Trust, BlackRock's custodian, Coinbase, goes into the Bitcoin market and buys real Bitcoin and holds it. Your share represents a fractional claim on that actual Bitcoin. The price of your share tracks the spot price of Bitcoin directly because the fund holds Bitcoin directly. A futures ETF does not hold the underlying asset. It holds futures contracts, agreements to buy or sell Bitcoin at a specified price on a specified future date, traded on a regulated exchange like the Chicago Mercantile Exchange. ProShares launched BITO, the first Bitcoin-linked ETF approved in the United States, in October 2021, and it was a futures ETF. It held CME Bitcoin futures contracts, not Bitcoin. Why does that distinction matter? Because futures contracts expire. When a futures contract approaches its expiration date, the fund has to sell the expiring contract and buy the next one, a process called rolling. In a market where futures prices are higher than spot prices, a condition called contango, which is the normal state for Bitcoin futures, Rolling contracts continuously costs money. The fund sells low and buys high, month after month, creating a persistent drag on returns that can cause significant divergence between the ETF's performance and Bitcoin's actual price performance over time. This is not a theoretical problem. Bitcoin futures ETFs underperformed spot Bitcoin over extended holding periods because of this structural cost. For a long-term Bitcoin investment strategy, holding a futures ETF instead of spot Bitcoin is a meaningful disadvantage. You are paying a rolling cost that compounds over time, and your exposure is indirect, not direct. A spot Bitcoin ETF eliminates both problems. No rolling cost, no tracking error from futures dynamics, just Bitcoin, held in custody, tracked directly. The United States Securities and Exchange Commission approved futures Bitcoin ETFs starting in October 2021. It refused to approve spot Bitcoin ETFs for more than a decade, from the first application in 2013 through the end of 2023. Every single application was rejected. That decade of rejections is the story that makes January 11th, 2024 mean what it means. On July 1st, 2013, Tyler and Cameron Winklevoss filed an application with the Securities and Exchange Commission to list a Bitcoin exchange-traded product on the BATS exchange. Bitcoin was trading at approximately $100. The Winklevoss twins, who had become wealthy from their legal settlement with Mark Zuckerberg over Facebook and had used that capital to accumulate a significant Bitcoin position, saw the same opportunity that every subsequent applicant would see. Bitcoin was an asset that millions of people wanted exposure to, but accessing it directly was complicated, technical, and risky. An ETF wrapper would solve that problem and bring enormous capital into the asset class. The SEC did not agree. Not in 2013. Not in 2014. Not in 2015 or 16. The first formal rejection came in March 2017 when the SEC denied the Winklevoss Bitcoin Trust application after nearly 4 years of review. The Commission rejected it again in July 2018, this time by a 3-to-1 vote at the commissioner level. The rejections were not about Bitcoin's legitimacy as an asset. They were about a specific, technical, legal requirement rooted in the Securities Exchange Act of 1934. Section 6, subsection B, Clause 5 of the Exchange Act requires that any securities exchange seeking to list a new product must demonstrate that its rules are designed to prevent fraudulent and manipulative acts and practices. In practice, the SEC interpreted this requirement to mean that a spot Bitcoin ETF could only be approved if the exchange listing it had a surveillance sharing agreement with a regulated market of significant size. A market regulated well enough that manipulative trading in that market could be monitored, identified, and investigated. The problem was that in 2013, 2017, 2020, and 2022, the Bitcoin market did not have a regulated venue of sufficient size and quality to satisfy that requirement. Bitcoin traded primarily on unregulated cryptocurrency exchanges, Bitfinex, Binance, Kraken, and others that operated outside of the SEC's regulatory jurisdiction. Without a regulated market to share surveillance data with, the SEC argued, it could not verify that the price of a spot Bitcoin ETF was not being manipulated. This argument had a structural flaw that would eventually become legally decisive, but not until 2023. The flaw was this. The SEC approved Bitcoin futures ETFs in 2021. The ProShares BITO ETF launched in October of that year. BITO held futures contracts traded on the Chicago Mercantile Exchange, a regulated venue with robust surveillance. The SEC approved it quickly. But here was the logical problem. Bitcoin futures contracts derive their price from the Bitcoin spot market. If the spot market was too manipulated and unregulated to support a spot ETF, how could a futures ETF, whose prices are derived from that same spot market, be considered safe? The prices are connected. If the spot market is manipulable, futures prices are also affected. The SEC never resolved this contradiction. It simply kept approving futures products and rejecting spot products, offering a rationale that applied differently to instruments whose underlying exposure was economically similar. Several applicants tried to satisfy the SEC's requirements through various means. VanEck and SolidX applied in 2019 with a proposal to back each ETF share with 5 Bitcoin per share, arguing that the high per-share price would limit retail speculation. Withdrawn before formal rejection. Fidelity's wise origin. Bitcoin Trust applied in March 2021, rejected in January 2022. Bitwise applied multiple times with detailed analysis, arguing that the regulated Bitcoin futures market and the Coinbase spot exchange were so correlated that surveillance of one was effectively surveillance of the other. Rejected. The legal and regulatory infrastructure of the crypto exchange space was evolving rapidly during this period, but the SEC consistently found reasons to conclude it had not evolved enough. In the circular logic of the situation, you cannot have a spot ETF until the market is regulated enough. The market will not be regulated enough until institutional capital arrives through vehicles like ETFs, meant the door appeared permanently closed, until one company did something that had not been done before, until Grayscale went to court. If you're still here after the 10-minute mark, give yourself a pat on the back. Most viewers don't make it this far into a detailed breakdown like this. The fact that you're still watching shows real discipline and genuine interest in understanding how institutional infrastructure actually changes an asset class. I respect that. Quick favor while we're here. If you're enjoying the video so far, please hit the like button. It really helps the channel and tells the algorithm that this kind of deep Bitcoin ETF analysis deserves to reach more people. And if you haven't already, subscribe and turn on notifications so you don't miss the rest of this series. Now let me know you're here. Comment with your city and country, what time it is right now where you are, and how the weather is over there. I love seeing how global this community really is. People watching from completely different time zones and climates, all trying to understand the same structural shifts in Bitcoin. Go ahead and drop your comment below. I read every single one. Let's keep going. 3 things broke the decade-long deadlock. They happened in sequence. Each one was necessary. None of them alone would have been sufficient. The first was a federal court ruling. Grayscale Investments had been running the Grayscale Bitcoin Trust, GBTC, since 2013. GBTC was not an ETF. It was a closed-end trust that held Bitcoin and sold shares to accredited investors in private placements. Those shares could eventually be traded on the secondary market, but they could not be redeemed directly for Bitcoin, which meant the trust's share price frequently diverged from Bitcoin's actual value, sometimes trading at a substantial premium, sometimes at a substantial discount. The discount problem became severe in 2022. As the crypto market collapsed following the failure of FTX and the broader bear market, GBTC shares traded at discounts to net asset value exceeding 40%. Investors who had bought GBTC as a Bitcoin investment strategy were holding a product worth far less than the Bitcoin it represented, with no mechanism to close the gap. Grayscale's proposed solution was to convert GBTC into a spot Bitcoin ETF. Doing so would allow authorized participants to create and redeem shares directly based on net asset value, eliminating the discount. In October 2021, the same month BITO launched, Grayscale formally applied to convert GBTC into a spot ETF. The SEC rejected the conversion. In June 2022, citing the same surveillance sharing rationale it had used for every other rejection, Grayscale sued. The case went to the United States Court of Appeals for the District of Columbia Circuit. On August 29, 2023, Judge Naomi Rao delivered the opinion. The court found that the SEC's rejection was arbitrary and capricious, the legal standard for administrative decisions that cannot withstand scrutiny. The court's reasoning went directly to the logical contradiction described in the previous section. The SEC had approved Bitcoin futures ETFs without the surveillance sharing arrangements it claimed were necessary for spot ETFs, and had not coherently explained why futures products were acceptable while economically similar spot products were not. The SEC declined to appeal. The door cracked open. The second piece was BlackRock. On June 15, 2023, more than 2 months before the Grayscale ruling, BlackRock filed an application to list an iShares Bitcoin Trust on the NASDAQ. BlackRock manages approximately $14 trillion in assets. It is the largest asset manager in the world. It has filed for ETF approval with the SEC hundreds of times in its history. Its approval rate is extraordinary. When BlackRock files for something, markets pay attention in a way they do not for smaller applicants. But the application itself was not what made this different. What made it different was who BlackRock named as its surveillance sharing partner. On July 3, 2023, BlackRock refiled its application, this time naming Coinbase as its surveillance sharing partner and specifying the terms of a surveillance sharing agreement between the NASDAQ and Coinbase. This was the specific legal architecture the SEC had said was missing from every prior application. Coinbase, at the time, represented approximately 56% of dollar to Bitcoin trading volume on United States-based platforms. It was the dominant regulated venue for Bitcoin spot trading in the country. The argument BlackRock was making was precise. Coinbase is large enough, regulated enough, and transparent enough to constitute the kind of significant regulated market whose surveillance data satisfies the requirement of Section 6b-5. Monitor Coinbase's trading, and you can monitor the manipulation risk in the Bitcoin spot market. Other applicants quickly amended their own filings to adopt similar structures. The logjam that had held for a decade began to visibly shift. The third piece was the political and regulatory context. In 2023, the composition of the SEC and its relationship to the crypto industry was an active transition. The legal pressure from the grayscale ruling, the credibility pressure from BlackRock's application, and the political pressure from a Congress increasingly focused on crypto regulation created a set of conditions in which continued blanket rejection of spot ETF applications carried mounting legal and institutional risk for the Commission itself. Bloomberg Intelligence ETF analysts Eric Balchunas and James Seifert, two of the most closely followed analysts in the ETF industry, raised their probability estimate for spot Bitcoin ETF approval to 90% in October 2023. The professional ETF community, which had watched this process for a decade, believed the end of the rejection era was at hand. They were right. The SEC began engaging in substantive back and forth with applicants on the specific technical requirements for their filings, the kind of iterative dialogue that precedes approval, not rejection. Applicants disclosed their fee structures. They finalized their surveillance sharing agreements. They specified their custodial arrangements. The process was moving toward a conclusion that had seemed structurally impossible 12 months earlier. By early January 2024, the approval was not a matter of if, but when. Bitcoin had already moved in anticipation. From approximately $16,000 in the depths of the 2022 bear market, Bitcoin had recovered to around $42,000 entering the new year. A rally, driven substantially by the expectation that institutional access through a regulated vehicle was finally arriving. Anyone assembling a digital asset portfolio in late 2023 was pricing in the ETF as a near certainty. The final weeks before the approval produced one of the stranger episodes in modern financial markets. On January 3rd, 2024, 8 days before the actual approval, a research report from a firm called Matrixport circulated claiming that the SEC was likely to reject all spot Bitcoin ETF applications. The report contradicted months of signals from applicants, regulators, and industry analysts. Bitcoin fell from approximately $45,000 to $40,000, $600 in hours as traders reacted. The dip was sharp and brief. Most serious analysts dismissed the Matrixport report within hours. Bitcoin recovered. Then came January 9th. At 4:11 p.m. Eastern Time on January 9th, the official Twitter account of the Securities and Exchange Commission posted a message stating that the SEC had approved spot Bitcoin ETFs for listing on United States exchanges. The crypto market erupted. Bitcoin surged toward $48,000 in minutes. 47 minutes later, SEC Chair Gary Gensler posted from his personal account that the SEC's official account had been compromised. The post was false. The approval had not happened. The FBI subsequently arrested Eric Council Jr. in connection with the SIM swapping attack that compromised the SEC's account. The hack was the last convulsion of anticipation before the real event arrived. The following morning, January 10th, 2024, the SEC voted to approve 11 spot Bitcoin ETF applications simultaneously. The products began trading on January 11th. The 11 funds that launched that day were BlackRock's iShares Bitcoin Trust, trading under the ticker IBIT, Fidelity's Wise Origin Bitcoin Fund, trading as FBTC, ARK Invest, and 21 shares. ARK 21 shares Bitcoin ETF, Bitwise Bitcoin ETF, the converted Grayscale Bitcoin Trust, Van Eck Bitcoin Trust, Wisdom Tree Bitcoin Fund, Invesco Galaxy Bitcoin ETF, Valkyrie Bitcoin Fund, Franklin Bitcoin ETF, and Hashdex Bitcoin ETF. 11 products. One day. A decade in the making. The immediate market reaction did exactly what it does with long-anticipated events. It sold the news. Bitcoin, which had been trading around $46,000 in the hours before the announcement, fell below $40,000 in the days following the launch. The narrative that immediately emerged was that the ETF was priced in, that the rally from $16,000 to $46,000 had already discounted the approval, and that now reality would be a disappointment. This narrative was spectacularly wrong, but it took several weeks for the data to demonstrate how wrong it was. The first thing that happened in the immediate aftermath was the grayscale factor. GBTC, which had been a closed-end trust with approximately 630,000 Bitcoin and a 2% annual management fee, was now an ETF. Investors who had been trapped in GBTC's discount structure for years immediately began redeeming shares. In the first days of trading, GBTC saw outflows of approximately 25,000 Bitcoin. That selling pressure overwhelmed the inflows into the new ETFs and suppressed Bitcoin's price. But underneath the GBTC liquidation noise, something else was happening. In the first 3 days of trading, IBIT added approximately 16,000 Bitcoin. FBTC added approximately 12,000 Bitcoin. Fresh capital was arriving, not recycled GBTC capital rotating into cheaper alternatives, but new institutional money entering the Bitcoin market for the first time through a vehicle they could actually use. By the end of the first week, the 11 ETFs collectively held more new Bitcoin than GBTC was selling. The net flow turned positive, and then it kept going. 63 days after the approval, On March 14th, 2024, Bitcoin reached a new all-time high of $73,737. That was only the first peak. The real institutional demand that the ETF pipeline had opened continued to build throughout 2024. By late 2025, Bitcoin had surpassed that level significantly, reaching new all-time highs above $100,000 as the cumulative effect of sustained institutional inflows compounded against the tightening supply created by the April 2024 halving. The sell the news crowd had sold the beginning of the largest sustained institutional inflow into Bitcoin in the asset's history. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. There have been approximately 3,000 exchange-traded funds launched in the United States over the past 30 years. None of them did what IBIT did. Let me be precise about the numbers, because the scale of what happened requires precision to be properly understood. IBIT launched on January 11, 2024, with an expense ratio of 25 basis points, 0.25% annually. This was dramatically lower than GBTC's 2% fee, lower than most commodity ETFs, and competitive with the lowest cost equity index funds in the market. BlackRock was pricing IBIT to win market share, understanding that in the ETF business, low costs compound into dominant scale over time. In its first 11 months of operation, IBIT accumulated $50 billion in assets under management. By 341 days after launch, still within its first year of trading, it had surpassed $70 billion, setting a record for the fastest ETF to reach that milestone in the history of exchange-traded products. In some moments during the Bitcoin price, peaks of 2025, IBIT's assets approached $100 billion. To understand what that trajectory means, consider the comparison that Bloomberg ETF analyst Eric Balchunas made when the 50 billion milestone was reached. The iShares Core MSCI EAFE ETF, one of BlackRock's own flagship international equity products, a fund tracking thousands of stocks across developed markets in Europe, Asia, and Australia, took nearly 4 years to reach $50 billion in assets. IBIT reached the same milestone in 11 months, 5 times faster than the second fastest ETF BlackRock had ever launched, in any asset class, in the history of the firm. As of April 2026, IBIT holds approximately 782,000 Bitcoin, slightly below its all-time peak holdings during the 2025 price highs, reflecting normal fluctuations in ETF creation and redemption activity. Its assets under management sit at approximately $50 to $54 billion, a figure that moves with Bitcoin's price. What matters is not the precise snapshot in any given week. It is the trajectory. $70 billion reached in less than a year, consistent positioning as BlackRock's top revenue-generating product in peak periods throughout 2025, an estimated $245 million in annual fee generation at peak AUM levels. James Seifert, the Bloomberg Intelligence ETF analyst who had spent years tracking the approval process, stated the case plainly: IBIT's growth is unprecedented. It's the fastest ETF to reach most milestones, faster than any other ETF in any asset class. Nate Garassi, president of the ETF store, called it the greatest launch in ETF history. These are not promotional statements from Bitcoin advocates. These are ETF industry professionals whose entire careers are built around analyzing the mechanics and performance of exchange-traded products. People who have watched thousands of fund launches and understand what normal looks like. They were saying, in plain language, that nothing they had ever seen was comparable to what IBIT did. The inflow record is the clearest illustration. In its first year of trading, IBIT saw predominantly positive net inflows. The pattern was so one-directional that analysts repeatedly noted how unusual it was for a newly launched fund. This kind of sustained buying pressure is extraordinarily rare for any financial product. It reflects the pent-up demand from institutional investors, pension funds, endowments, registered investment advisors, wealth managers, family offices, who had been unable to access Bitcoin through their existing infrastructure for years, and who moved with deliberate speed once the vehicle they needed finally existed. The cumulative net inflows across all 11 spot Bitcoin ETFs from January 2024 through early 2026 exceeded $56 billion. The collective AUM of the products has ranged between $87 and $107 billion, depending on Bitcoin's price at any given moment, reflecting the fact that these funds hold a fixed quantity of Bitcoin whose dollar value moves with the market. At various points during 2025, the 11 funds collectively held approximately 1.29 million Bitcoin, representing roughly 6 to 6.5% of the entire circulating supply of the asset. For context on what that number means, Bitcoin has a fixed maximum supply of 21 million coins. It cannot be inflated. No central bank can create more of it. When entities collectively hold over 1 million Bitcoin in regulated custodial vehicles, those coins are effectively removed from the liquid market. They are not being traded actively. They are being held by institutional investors pursuing a long-term Bitcoin investment strategy. The available supply that can be bought and sold in the market contracts. When demand is stable in supply contracts, price goes up. This is not a theory. It is the arithmetic of fixed supply assets. The IBIT trading volume data reveals another dimension of dominance. Within months of launch, IBIT was capturing more than 50% of all daily trading volume among Bitcoin ETFs, despite having 10 competitors launched on the same day. IBIT regularly trades more daily volume than many of the most established equity ETFs in the market, products with decades of history and tens of billions in assets. The institutional infrastructure that BlackRock brought to the product was part of what drove this. IBIT's authorized participant network, the large financial institutions that create and redeem ETF shares to keep the price aligned with net asset value, included the most sophisticated fixed income and equity trading desks in the world. The custodial arrangement with Coinbase provided institutional-grade Bitcoin storage. The fund's operational architecture was built to the standard that pension funds and endowments require before allocating capital to any product. This was not just a Bitcoin product, it was a BlackRock product. And the BlackRock brand, distribution network, and institutional relationships are among the most valuable in global finance. Here's the question that matters for anyone thinking seriously about Bitcoin as part of a long-term financial strategy. Not, did IBIT perform well in its first year? The question is, did IBIT change Bitcoin's market structure in a way that is permanent and compounding? The answer is yes, in 4 specific ways. The first is the supply lock. Every Bitcoin that flows into a spot ETF is Bitcoin that is custodied, held in cold storage by a regulated custodian, inaccessible for active trading, and unavailable to satisfy spot market demand. When IBIT holds approximately 782,000 Bitcoin, those coins are not on any exchange. They are not available to short sellers. They are not circulating. The liquid float of Bitcoin, the amount actually available for buying and selling on exchanges, shrinks every time net inflows into ETFs exceed net outflows. This is structurally different from the situation before January 2024. Before the ETF, institutional investors who wanted Bitcoin exposure had limited options. Some bought Bitcoin directly and held it themselves, or through crypto-native custodians. Some bought GBTC, which held Bitcoin, but allowed its shares to trade at discounts that disconnected the demand for the product from actual Bitcoin buying. Very few could access Bitcoin through their standard brokerage and custody infrastructure because the regulatory and operational framework simply did not exist. The ETF created a direct pipeline between traditional financial capital and the Bitcoin spot market. Every dollar that flows into IBIT results in $1's worth of Bitcoin being purchased and custodied. The pipeline is one directional as long as the capital stays in the product. And the capital profile of ETF investors, pension funds allocating to a 20-year time horizon, wealth managers constructing strategic digital asset portfolios for clients, means the holding periods tend to be long. The second structural change is the demand floor. Before the ETF, Bitcoin's demand came almost entirely from a relatively narrow universe of participants: retail investors, crypto-native funds, corporate treasuries like MicroStrategy, and a small number of pioneer institutional allocators. The demand was volatile, sentiment-driven, and highly correlated with the crypto market cycle, which itself was closely tied to the 4-year Bitcoin halving cycle that cuts the rate of new supply in half approximately every 4 years. After the ETF, Bitcoin's demand base expanded to include the entire universe of traditional institutional capital. Morgan Stanley, with more than 15,000 financial advisors, moved to offer spot Bitcoin ETFs to clients. Bank of America, Goldman Sachs, and Wells Fargo followed. Sovereign wealth funds conducted allocation analyses. BlackRock itself published a paper arguing that a 1 to 2% Bitcoin allocation in a diversified portfolio was justifiable from a risk-adjusted return perspective given Bitcoin's low correlation with traditional assets. When one of the world's largest asset managers publishes a paper arguing for Bitcoin allocation in a diversified crypto portfolio strategy, that paper lands on the desk of every investment committee that allocates to BlackRock products. Those committees control tens of trillions of dollars. The demand floor that the ETF created is not just the current level of institutional allocation. It is the pipeline of capital that has not yet arrived. The endowments still evaluating, the sovereign wealth funds still conducting due diligence, the pension funds still waiting for board-level approval of a new asset class allocation. Every one of those pools represents future demand that did not exist before January 2024. The third structural change is the price discovery mechanism. Before the ETF, Bitcoin's price was discovered primarily on cryptocurrency exchanges, Binance, Coinbase, Kraken, and others, with significant volume on offshore venues that operate outside United States regulatory jurisdiction. The price discovery process had characteristics that made traditional institutional investors uncomfortable. Thin order books relative to the asset's market cap, significant volume on unregulated venues, and price action that could be substantially moved by large transactions on specific exchanges. After the ETF, a meaningful portion of Bitcoin price discovery happens through the ETF creation and redemption mechanism, a regulated process overseen by the SEC, executed through authorized participants who are major regulated financial institutions, and conducted transparently with publicly disclosed holdings and daily valuation. The authorized participants, entities like Goldman Sachs, JP Morgan, and Citadel Securities, bring with them the full weight of their market-making infrastructure, their risk management systems, and their regulatory accountability. The result is a more liquid, more transparent, and more institutionally credible price discovery process. Bitcoin's spot price is increasingly being formed through regulated venues by regulated entities, which is precisely what the SEC said was necessary before it could approve a spot ETF. The approval created the very conditions it required. The fourth structural change is legitimacy by association. This one is harder to quantify, but arguably the most significant in the long run. When BlackRock, with approximately $14 trillion under management, with its iShares, brand the most trusted name in exchange-traded funds globally, puts its name on a Bitcoin product and markets it to pension funds, endowments, and individual investors, it makes a statement about Bitcoin that no amount of Bitcoin advocacy could make. Larry Fink called Bitcoin an asset of fear, a store of value that people turn to when they lose confidence in their currency and their government. He said it from the stage at the New York Times Dealbook Summit. He said it on Bloomberg Television. He said it in interviews read by the financial advisors who manage the retirement savings of tens of millions of Americans. Larry Fink called Bitcoin an index of money laundering in 2017. The distance between those two statements, between 2017 and 2025, is the distance that Bitcoin traveled from fringe asset to institutional legitimacy. And IBIT is both the symbol of that journey and one of its primary causes. The approval of IBIT did not just give institutional investors access to Bitcoin. It gave Bitcoin the imprimatur of the institution that had spent decades building the most trusted ETF franchise in the world. That legitimacy compounds. Every quarter that IBIT generates revenue for BlackRock, every earnings call where management discusses the Bitcoin ETF business, every Morgan Stanley advisor who recommends a Bitcoin ETF allocation to a client, these are data points that make the next institutional investor's decision to allocate easier. The network effects of institutional legitimacy are self-reinforcing. I have spent the last 6 sections of this video making the case for what the spot Bitcoin ETF is, why it matters, and how it has changed Bitcoin's market structure. Now, I want to do something that I think is equally important. I want to tell you what it is not. Because the enthusiasm around IBIT and the broader ETF approval is real and justified, but it has generated a set of misconceptions that are worth addressing directly. If you are evaluating a Bitcoin investment strategy and considering whether to use an ETF, a self-custody wallet, a crypto exchange, or some combination of all three, these distinctions matter. The first thing an ETF is not, it is not Bitcoin. When you buy IBIT, you do not own Bitcoin. You own shares in a trust that owns Bitcoin. That distinction sounds semantic, but it has real implications. If you hold Bitcoin in a self-custody wallet, a hardware wallet like a Ledger or Trezor, or a software wallet where you control the private keys, you have something that no counterparty can take from you, freeze, or restrict access to. Your Bitcoin is controlled by your private key. No government, no company, no exchange, no bankruptcy proceeding can prevent you from transacting with your Bitcoin as long as you have your private key. If you hold IBIT shares, you have counterparty exposure. You trust BlackRock to operate the fund as stated. You trust Coinbase as custodian to hold the Bitcoin securely. You trust the SEC regulatory framework to function as designed. You trust your broker to settle trades accurately. None of these are unreasonable trusts. They are the same trusts you extend to every other financial product you own. But they are trusts, and they are not the same thing as holding the asset directly. In the context of Bitcoin specifically, this distinction carries philosophical weight. Bitcoin was created precisely as an alternative to systems that require institutional trust. a way to hold and transfer value without depending on banks, governments, or financial intermediaries. Buying Bitcoin through a BlackRock ETF, while operationally convenient, means using Bitcoin's price appreciation as an investment return while outsourcing the sovereignty that makes Bitcoin what it is. You are getting the financial exposure without the monetary property. For many investors, particularly those using Bitcoin purely as a financial asset within a broader crypto portfolio allocation, this trade-off is entirely reasonable. The convenience, the regulatory protection, the tax reporting simplicity, and the integration with existing brokerage infrastructure are worth the counterparty exposure for investors whose primary interest is price appreciation rather than monetary sovereignty. But it is important to understand the trade-off you are making. The second thing, an ETF is not. It is not a guarantee against drawdown. Bitcoin fell from $69,000 in November 2021 to $15,000 in November 2022, a drawdown of approximately 78%. IBIT did not exist during that period, but the spot Bitcoin ETFs that launched in January 2024 experienced their own significant volatility. Bitcoin pulled back substantially from its March 2024 highs before recovering and setting new records in late 2024 and 2025. Anyone who bought IBIT near peak 2024 prices and sold during the subsequent correction experienced real losses. The ETF wrapper does not protect you from the volatility of the underlying asset. It just makes the asset more accessible. Bitcoin's volatility profile is unlike any mainstream investment. Its annualized volatility has historically been multiple times that of equities. A 2% Bitcoin position in a diversified portfolio, as BlackRock's own analysis suggests, is meaningful exposure to an asset that can move 20, 30, or 50% in either direction within weeks. The ETF makes it easier to buy Bitcoin. It does not make Bitcoin easier to hold psychologically. Anyone building a long-term Bitcoin investment strategy through ETFs needs to have a clear view of their time horizon and their tolerance for drawdown. The investors who suffered most in the 2022 bear market were those who had bought at elevated prices with short time horizons and sold at losses when the drawdown exceeded what they could emotionally tolerate. The ETF structure makes it very easy to click sell during a drawdown, just as easy as it made it to click buy. The third thing, an ETF is not. It is not free. IBIT charges 25 basis points per year. On a $50,000 position, that is $125 annually. On a $500,000 position, $625 per year. Compounded over a decade, the fee drag represents real money relative to holding Bitcoin directly. Self-custody Bitcoin has essentially zero ongoing cost once you have paid for the hardware wallet. A ledger costs approximately $100 and lasts many years. Holding Bitcoin in self-custody through a properly secured hardware wallet costs nothing annually and involves no counterparty. For small positions over short holding periods, the convenience of an ETF easily justifies the fee. For large positions over long holding periods, the arithmetic of 25 basis points annually compounded becomes meaningful. This is not a reason to avoid ETFs. It is a reason to be aware of what you are paying and why. The fourth consideration is the tax structure. In the United States, Bitcoin held directly can be subject to long-term capital gains treatment if held for more than 1 year. Bitcoin ETF shares are taxed the same way as other securities held through brokerage accounts. In tax-advantaged accounts, IRAs, Roth IRAs, 401k plans, Bitcoin ETF shares can be held with the same tax advantages as any other security, which is a meaningful advantage that direct Bitcoin ownership cannot easily replicate. But in taxable accounts, the ETF does not provide a tax advantage over direct ownership, and it adds the expense ratio. Investors with significant Bitcoin positions in taxable accounts who are primarily motivated by long-term appreciation may find direct ownership more efficient. The fifth risk is regulatory. The SEC approved spot Bitcoin ETFs in January 2024 under a specific set of market conditions and a specific regulatory leadership. Regulatory conditions change. While it would be politically and legally very difficult to reverse the approval of existing ETFs, doing so would create enormous legal liability and market disruption. Future regulatory changes could affect how ETFs are taxed, how their custody arrangements are regulated, what disclosures are required, and how they interact with the broader financial system. Bitcoin itself is also subject to ongoing regulatory uncertainty in many jurisdictions. An ETF wrapper does not insulate you from the underlying regulatory risk of the asset. None of these bear case points undermine the significance of what IBIT represents or the structural changes it has created in Bitcoin's market. They are the honest accounting of what you get and what you give up when you choose to access Bitcoin through an exchange-traded fund rather than directly. Understanding that accounting is how you make the choice that is right for your specific situation, not for the average investor, not for the institutional allocator, but for you. Let me bring this back to where we started. That 62-year-old retirement planner in Dallas, the Fidelity account, the 4 letters, the 30-second transaction. What he did on January 11th, 2024, buying Bitcoin through his existing brokerage infrastructure without wallets, without private keys, without a crypto exchange account, was structurally impossible before that date in any meaningful institutional grade form. Not because of technological limitations, because of regulatory ones. Because for 10 years and 7 months, from July 2013 to January 2024, the Securities and Exchange Commission concluded that the Bitcoin spot market was not sufficiently regulated, not sufficiently surveilled, not sufficiently protected against manipulation to serve as the basis for an exchange-traded product. That conclusion was not arbitrary. It reflected real concerns about a young, volatile, globally distributed asset market that operated largely outside of traditional regulatory jurisdiction. The concerns were legitimate, even if the application of them, approving futures ETFs while rejecting spot ETFs, treating economically similar exposures as categorically different, was not coherent. What broke the deadlock was a combination of legal pressure, institutional credibility, and market maturation arriving at the same moment. Grayscale's court victory established that the SEC's rationale was legally incoherent. BlackRock's application, with its Coinbase surveillance sharing agreement and its institutional credibility, provided the specific architecture the SEC had said was required. And the broader regulatory and political context in late 2023 made continued blanket rejection a position the Commission could not sustain. The result was January 10th, 2024. 11 products approved in a single day. A decade of friction eliminated in a single vote. Now let me be precise about what changed structurally and why it is permanent. The capital that has entered Bitcoin through spot ETFs since January 2024 is not temporary speculative capital looking for a quick trade. It is the beginning of a long-duration institutional allocation cycle. Pension funds and endowments do not buy assets in order to sell them in 6 months. They buy assets because they have made a strategic determination about long-term risk-adjusted returns, and they adjust those positions gradually over years. The institutions that are currently underweighting Bitcoin relative to what their analysis suggests is optimal, those that are still completing their due diligence, still getting board approval, still navigating fiduciary frameworks, represent future inflows that have not yet arrived. The Bitcoin halving that occurred in April 2024, cutting the rate of new Bitcoin entering circulation from approximately 900 coins per day to approximately 450, means the supply side of the Bitcoin market was simultaneously tightening as institutional demand was beginning to flow through the ETF pipeline. Fixed supply cut in half. New demand pipeline open for the first time. The arithmetic of those two forces, operating simultaneously, is the context in which Bitcoin broke its previous all-time highs in 2024, continued to new records through 2025, and established itself as a permanent fixture of institutional portfolio construction. Larry Fink, who manages approximately $14 trillion and has spent 40 years at the center of global capital allocation, has said publicly that a 2 to 5% sovereign wealth fund allocation to Bitcoin could support a dramatically higher price per coin. This is not a prediction. It is arithmetic applied to the scale of sovereign wealth fund assets relative to Bitcoin's fixed supply. Whether you believe the allocation will happen on that scale or at a fraction of it, the direction of the analysis points in one direction. The institutional infrastructure that now exists, the ETFs, the custodial arrangements, the regulatory framework, the distribution networks of the world's largest wealth managers, does not get uninvented. It compounds. Every quarter that passes with IBIT as a top BlackRock revenue contributor in peak periods, every earnings call where management discusses the Bitcoin ETF business, every financial advisor who recommends a Bitcoin allocation to a client and watches that client's portfolio perform as modeled. These are reinforcing cycles that make the next institutional investor's decision easier, not harder. The bear case, stated honestly, is that institutional adoption could stall, that a severe Bitcoin bear market could create political pressure for increased regulation that constrains ETF distribution or imposes new costs, that the counterparty risks embedded in the ETF structure could materialize in ways that damage investor confidence, that Bitcoin's technological evolution, layer 2 solutions, changes to the base protocol, could alter the asset's characteristics in ways that affect its investment thesis. These risks are real. They are not reasons to dismiss the significance of what has happened. They are reasons to hold the investment thesis with appropriate humility and to size positions accordingly. Here is what the evidence supports as a conclusion from everything we have examined in this video. January 11th, 2024 is a line. On one side of that line is a Bitcoin that was primarily accessible to a relatively small universe of technically sophisticated or risk-tolerant participants. People willing to manage private keys, navigate crypto exchange platforms, deal with the operational complexity of direct ownership, and accept the reputational and regulatory uncertainty that came with being an early adopter of an asset the financial establishment had not yet legitimized. On the other side of that line is a Bitcoin that is accessible to every investor with a brokerage account, that is held in custody by the world's most trusted custodians, that is marketed by the world's largest asset manager, that is recommended by the financial advisors at Morgan Stanley, Bank of America, and Wells Fargo, that sits inside IRA accounts and 401k plans alongside index funds and bond ETFs. That appears on the same brokerage statements as Apple stock and Treasury bonds. The Bitcoin, the post-ETF Bitcoin, is a structurally different market than the one that existed before. Not because Bitcoin itself changed. The protocol is the same. The 21 million supply cap is the same. The 4-year halving cycle is the same. The decentralization, the censorship resistance, the mathematical scarcity, all unchanged. What changed is who can access it. And in financial markets, access is everything. The 10 years and 7 months between the Winklevoss application and the approval were not wasted years. They were the years during which Bitcoin proved, through multiple market cycles, through regulatory hostility, through exchange collapses and protocol attacks and bear markets that exceeded 75% drawdowns, that it was not going away, that it was not a passing experiment, that its fundamental value proposition, a fixed supply, decentralized, mathematically enforced store of value, was durable enough to attract permanent capital. The ETF approval was not the beginning of that story. It was the moment the story became legible to the mainstream financial system. And the mainstream financial system, once it begins paying attention to an asset, does not stop. That is what January 11th, 2024 means. That is why BlackRock's IBIT changed Bitcoin forever. You have the map. If you stayed until the very end, thank you. Seriously, it takes real focus and discipline to go through a video this detailed from start to finish. You're not just watching, you're studying how BlackRock's IBIT permanently changed Bitcoin's market structure. That puts you in a very small group of people who truly get what happened on January 11th, 2024. Now it's your turn to show you're committed. Comment below with exactly "I see the diamond" if you understood the full picture and you're locked in on what this means for Bitcoin going forward. Also tell me, your city and country, what time it is there right now, how the weather is over there. One of the things I enjoy most about creating content is seeing how truly global our community has become. Thousands of people from every corner of the world, watching at different hours, all chasing the same architectural understanding of Bitcoin. Drop your comment right now. I read every single one. Thank you again for watching. See you in the next video, and stay sharp.